Trendlines are one of the most widely used tools in technical analysis, but most traders use them the wrong way. Instead of revealing trading opportunities, they end up drawing random lines on the chart and taking low probability trades. In this video, you will learn 4 powerful trendline trading strategies that show you how to use trendlines correctly to identify trend continuations, breakouts, and high probability retest setups. Let's get started. A trend line is simply a line drawn on a chart that connects important swing highs or swing lows and helps identify the direction of the market. Now let's move to the first trend line trading strategy. In this strategy, we combine a trend line breakout with a moving average crossover. Look at this chart example. As you can see, this is the 5-minute chart of the US dollar against the Canadian dollar. Here, the market starts trending upward. We draw our trend line by connecting the first and second swing lows. Then we add 2 moving averages, the 50-period simple moving average, the 21-period simple moving average. Now look at what happens next. As you can see, the market breaks below the trend line, and shortly after, the 21 moving average crosses below the 50 moving average. This bearish crossover indicates a potential trend change, and it confirms the trendline breakout. So notice something important here. We are not using the moving average crossover alone. It is only used as a confirmation tool after the breakout occurs. Now let's switch to the 1-hour time frame to understand the bigger picture. As you can see on the hourly chart, the market was ranging. A liquidity sweep occurred above this resistance level, which suggests that the market may now move downward. At the same time, we also see the moving average crossover, which supports the idea of a potential trend change. After the liquidity sweep, the market makes a small pullback, followed by a strong bearish candle. This indicates that sellers are stepping into the market. This higher timeframe analysis supports our bearish setup on the 5-minute chart. Now let's go back to the 5-minute chart to execute the trade. You place your entry at the close of the second candle that breaks below the trend line. Your stop loss goes above the recent high, and your target is the next key support level, aiming for at least a 2-to-1 reward to risk ratio. Now look at what happens next. As you can see, the market moves downward and hits the target as expected. Now look at another chart example. This is the 5-minute chart of the US dollar against the Canadian dollar. First, we draw the trend line by connecting the swing points. Now look at what happens next. The market breaks above the trend line, and shortly after, the 21 moving average crosses above the 50 moving average. This bullish crossover confirms the breakout and signals a potential move to the upside. Now let's switch to the 1-hour chart to see the bigger picture. As you can see, the market was ranging, price briefly broke below the range and then closed back above it. This is a clear liquidity sweep, which suggests that the market may continue moving upward, at least toward this resistance level. This higher timeframe analysis supports our bullish setup on the 5-minute chart. Now let's switch back to the 5-minute chart to execute the trade. Now we place the entry at the close of this candle. Set the stop loss below this swing low and the target at the next key level, aiming for at least a 2-to-1 reward to risk ratio. Now look at what happens next. As you can see, the market moves up and reaches the target as expected. There is one problem with this strategy. Sometimes the crossover happens too late, which can cause us to enter the trade late. As you can see in this example, the market breaks below the trend line and moves higher, but the moving average crossover appears after the move has already started. So if we wait for the crossover confirmation, we may end up entering too late. And look at what happens next. The market reverses. This doesn't mean the strategy doesn't work. Sometimes this simply happens, and it's part of trading. But is there another way to trade this setup without waiting for the crossover? Yes. And that brings us to the next strategy, which I call the bold breakout. Look at this chart example. The market was trending up, and we can clearly identify an uptrend trend line. Then something important happens. The market breaks below the trend line. This type of entry is called the bold breakout entry. It's called bold because you enter the trade immediately after the breakout, without waiting for additional confirmation. You place your entry at the close of the breakout candle, a stop loss above the candle, and the target below. And in this example, the market moves directly to the target. But does this happen every time? Of course not. If trading were that easy, anyone could open a trading account and make money consistently. Let's look at another example. The market is trending down, so we draw a trend line above price, connecting the swing highs. But then something interesting happens. Price fails to make a new low and starts forming higher lows. This is often an early sign that the selling pressure is weakening. Then price breaks above the trend line, signaling that buyers are gaining control of the market. This breakout can provide a potential opportunity to enter a long trade. But here's the key. A trend line break alone is not enough. We need extra confirmation to make sure it's real. To avoid false breakouts, we look for additional confirmation. One strong confirmation is the presence of double rejection patterns, such as double tops or double bottoms. In this example, the market is trending upward, but instead of continuing higher, price forms a double top. This shows that buyers tried twice to push the market higher, but failed. When price then breaks below the trend line, we now have two signals: a loss of bullish momentum, a structural break. Together, these signals create a strong short setup. The same concept works in the opposite direction. In a downtrend, the market forms a double bottom. This shows that sellers failed to push the market lower. When price then breaks above the trend line, it confirms that buyers are gaining control. This creates a high probability buy setup. Before executing the trade, we also check the higher time frame. For example, on this 5-minute gold chart, the market was trending upward and respecting a clear trend line. Eventually, price breaks below the trend line. But before entering the trade, we noticed two important signals: a double top pattern, a liquidity sweep above resistance. Price briefly broke above the level, triggered stop losses, and then quickly moved back down. This move trapped buyers and signaled a potential reversal. Next, we zoom out to the 1-hour chart. Here we see additional confirmation. The higher timeframe trend line has also been broken. Another liquidity sweep occurred near the double top. We also identify an order block that later becomes a breaker block. When price retests this breaker block, it gets strongly rejected, forming a bearish engulfing candle. This confirms strong selling pressure. Once the higher time frame aligns with the lower time frame, we can execute the trade. Entry is placed at the close of the bearish rejection candle. The stop loss goes just above the wick of that candle. The target is the next support level, ensuring a reward to risk ratio of at least 2-to-1. The next trendline strategy is called the break and golden retest strategy. Look at this chart. The market was previously trending down, and we have this clear bearish trend line. Now look at what happens next. The market breaks above the trend line with strong momentum, which indicates that buyers are stepping in and maybe changing the market direction. After the breakout, the market pulls back toward the broken trendline and gets rejected. This is a classic trendline break and retest setup. But there is something even more interesting here. We can see a strong impulsive move after the breakout. If we draw the Fibonacci retracement from the beginning of the move to the end of the move, we notice that the pullback reaches the 50% and 61.8% Fibonacci levels. This area is known as the golden retracement zone. When the market retraces into this zone and gets rejected, it often signals the end of the pullback and the beginning of the next impulsive move. So, in this setup, we don't only have a trendline break and retest, but we also have the 50% and 61.8% Fibonacci levels acting as support. That's why I call this setup the trendline break and golden retest strategy. Now let's check the higher time frame. On the higher time frame, the market is trending upward. Here we can see a resistance level that was previously broken. After the breakout, the market pulled back to that level, got rejected, and then started moving upward again. This suggests that the market may continue pushing higher. This higher time frame structure supports our bullish setup. Now let's switch back to the 5-minute chart to execute the trade. We place the entry at the close of the rejection candle. The stop loss goes below the recent swing low, and the target is the next key level, aiming for at least a 2-to-1 reward to risk ratio. Now look at what happens next. As you can see, the market moves upward and reaches the target as expected. Now look at another chart example. This is the US dollar, Canadian dollar 5-minute chart. As you can see, the market is trending upward, and we have a clear bullish trend line. We draw the trend line and then observe what happens next. The market breaks below the trend line, then pulls back to retest it and gets rejected. This is a classic trendline breakout and retest setup. Now let's add the Fibonacci retracement. We draw the Fibonacci from the beginning of the impulsive move to the end of it. As you can see, the market didn't only reject the trend line during the pullback, but it also got rejected from the 50% and 61.8% Fibonacci levels, which form the golden retracement area. So now we have a trend line break and golden retest setup. The next step is to check the higher time frame to understand the bigger picture. On the hourly time frame, the market was previously trending upward, then it got rejected and started trending downward. Here we have the first impulsive move, followed by a pullback. This suggests that the market may now be entering a new downtrend. If we apply the Fibonacci retracement to this move, we can clearly see that the pullback stops at the golden Fibonacci zone, around the 50% and 61.8% levels, before the market continues downward. This confirms that sellers are likely in control and supports our bearish setup on the 5-minute chart. Now let's go back to the 5-minute time frame to execute the trade. We place our entry at the close of the rejection candle. The stop loss goes above the recent swing high, and the target is the next key level, aiming for at least a 2-to-1 reward-to-risk ratio. Now look at what happens next. As you can see, the market moves downward and reaches the target as expected. So far, you've learned how to trade trend reversals using trend lines. Now let's move to the first trend following strategy. This one is called the Trendline bounce strategy, and it shows you how to use trend lines to trade with the trend instead of against it. Let's go through an example in an uptrend. First, identify the direction of the market. In this example, the market is clearly trending upward, forming higher highs and higher lows. We draw a trend line below price, connecting the swing lows. This trend line helps us visualize the structure of the trend and identify potential areas where buyers may step in again. Once the trend line is drawn, we wait for price to retrace back to it. Eventually, price pulls back and approaches the trend line. Instead of bouncing immediately, price briefly moves below the trend line before quickly closing back above it. At the same time, a bullish engulfing candle forms, showing strong buying pressure. This move often represents a liquidity sweep. When price moved below the trend line, many retail traders believed the trend line had broken. Some traders closed their buy positions, while others entered short trades expecting a bearish move. At the same time, the stop-loss orders of traders who bought near the trend line were triggered, but instead of continuing lower, the market quickly reversed. This trapped the sellers and signaled that the retracement was likely over. Before entering the trade, it's useful to confirm the setup using a higher time frame. Since this example appears on the 5-minute chart, we zoom out to the 1-hour chart. On the hourly chart, we notice that price recently performed a liquidity sweep at a support level. This indicates that buyers on the higher time frame may push the market toward the next resistance level. Now we have confirmation from both time frames. Once everything aligns, we can execute the trade. Enter the position at the close of the bullish engulfing candle. Place the stop loss below the low of the engulfing candle to protect against unexpected reversals. For the target, aim for the next resistance level, ensuring a reward-to-risk ratio of at least 2-to-1. Now let's look at the same strategy in a downtrend. First, identify the direction of the market. In this example, the market is clearly in a downtrend, forming lower highs and lower lows. We draw a trend line above price, connecting the swing highs. This trend line acts as a dynamic resistance level where sellers may step back into the market. Next, we wait for price to retrace back to the trend line. Eventually, price rallies toward the trend line, creating a potential short opportunity. When price reaches the trend line, it gets strongly rejected and forms a bearish pin bar. This candle shows that buyers tried to push the market higher but failed. The long wick of the pin bar shows that buyers attempted to break above the trend line. However, sellers quickly stepped in and pushed price back down. This rejection confirms that sellers are defending the trend line and that the downtrend may continue. To strengthen the setup, we check the higher time frame. Since the trade appears on the 5-minute chart, we zoom out to the 1-hour chart. On the hourly chart, we see that the market previously formed a double top pattern, which is a strong reversal signal. We also notice a liquidity sweep above the resistance level, which trapped buyers who expected a breakout. This suggests that the market may now move downward toward the next support level. Once the setup is confirmed, we can execute the trade. Enter the position at the close of the bearish pin bar. Place the stop loss above the wick of the rejection candle. For the target, aim for the next support level, ensuring a reward-to-risk ratio of at least 2-to-1. Now, you've learned 4 powerful ways to trade using trend lines. The key to success is not constantly switching strategies, but mastering one setup and applying it with discipline. If this video helped you, give it a thumbs up, subscribe to the channel, and turn on notifications so you don't miss the next one. Thanks for watching, and I'll see you in the next video.